Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, October 12th, 2021. Welcome back to the podcast, George.
Glad to be back, John.
Always good to have you. So it's been a couple weeks since your last podcast, and plenty has happened. Given the time that's passed, why don't we start off with you briefly updating our listeners on what has happened since your last episode and how the events over the intermediary period have impacted your views?
Sure. There's definitely a lot that's transpired since I've been last on the podcast, and kind of looking backwards, I think it's important to at least put them into context because they have set the stage for what looks like a potential breakout in rates. If we take a step back and look at the way the quarter Q3 ended, very much ironically enough close to the 1.5 target that I've had for a long time, but it took us a while to get there. Most of the actual rise in rates over the quarter took place in September. There was a big tug of war, a big rally initially throughout Q3, with the markets finally starting to break higher in rates during the end of the quarter, and a lot of it linked to a couple of factors. One, the overall supply chain disruptions and a kind of growing concern around an energy crisis more globally. Electricity prices and natural gas prices, have been on a rise in many overseas jurisdictions, and these global bond markets, being highly interconnected, have been feeding off each other, and so we've seen a kind of a market of one started to form here with the correlations of G10 plus global rates starting to move in the same direction, and that had its natural effect on driving U.S. rates higher. And in between all that period as well, the initial release higher in rates was long-term rates driven, with the 10-year pretty steepening pretty aggressively, and just overall long-term rates rising up until recently, and that was the big impetus in the move higher in rates. Again, above 150, and now somewhere around 160, a little bit south of that. And in the interim, while this was all going on, there was also a big focus around the debt ceiling, which was something that we mentioned on the last podcast as well as written about extensively over the last 2 weeks. That has been temporarily resolved with a kick the can type exercise to December, but by no means is it resolved. But it's another uncertainty that's been put on the back burner, at least for now, and that's also helped to push up rates. And the other thing which we've noticed, and which hopefully will continue, the delta or the change, no pun intended, but the change of the COVID-19 cases in the U.S. have turned for the better, and we've seen a pretty deep, sharp deceleration in new cases over the last couple of weeks, and that has had a pretty good correlation with the overall total return of the 10-year plus long sector of the Treasury market. And that's also been influencing it. So I would say it's a combination of some of the near-term uncertainty of the debt ceiling getting pushed back, COVID becoming less of at least a front and center issue for the markets, and this global rate phenomenon, concerns around inflation, starting to really factor back into the U.S. bond market.
Man, that's a lot. I mean, I certainly lived through it, but there's just a ton happened in the last couple of weeks. Excuse me. As a reminder to our listeners, we're recording this podcast on Tuesday, October 12th, ahead of the latest CPI report Wednesday and the PPI report Thursday. George, you sort of concluded with inflation there. And inflation is clearly the central focus point for many market participants here. And it's probably even more important than labor market data, I'd say, given the response to the weak payrolls report on Friday. Why don't we stick on this inflation topic and discuss where we are in this inflation cycle?
That's right. And so, speaking of the jobs report, which I didn't cover in the first question, but also critically important, we've had a second weak job report month in a row, but yet interest rates ended up higher on that day and continued in the overnight sessions. And the market's really kind of clued on or clued into the whole idea of wage inflation starting to become an issue if there's less sort of employment or the labor shortages continue to be out there, and so that kind of pushing up wage inflation. But the overall inflation cycle, it's going on September now. We'll see what numbers we get for CPI and PPI. However, this idea that this was going to be just transitory is now really being called into question, both because it's a global phenomenon, not just a U.S. phenomenon, and because there's just signs of it being sticky on all these different areas. And so disentangling the short-term disruptions as well as the energy spikes versus kind of an underlying service sector based wage inflation as labor shortages persist is starting to shift the narrative from transitory inflation to more of a persistent inflation that's going to be with us for many months, potentially into the winter and into next year. And so what many had thought, including myself, that up until now we would kind of get through these one-off factors of just the reopening type categories like hotel, entertainment services, and restaurants, and just the sectors that were being disrupted, like the automotive sector, like those were creating high inflation prints, but you would think that they would work themselves out over time. But now it looks like we're getting more of a broadening out of inflation pressures, and that is also kind of started to impact the bond market's thinking, because now we've twisted and turned the curve the other way. Today's Tuesday, it was a pretty big movements on the curve, although the moves in rates weren't terribly significant, but the actual twisting of the curve was a pretty big deal, and really showing that the markets are getting concerned about, is the Fed behind the curve? Will they have to do more? And I think that it's really coming to a head here. We're going to find out in the next couple of weeks. What's the Fed's plan, if they're going to actually launch taper or not, and how are they going to speak to this inflation problem that's looking to become much more sticky.
Yeah, absolutely. I think it was Bostic today that said he called inflation episodic, which I feel could be the new buzzword, if you will. But at the end of the day, speaking of the Fed, all this in some form or fashion comes back to what the markets think the Fed will do next, and what the Fed actually does. Vice Chair Clarita today said, and I'll quote, "I myself believe that the substantial further progress standard has more than been met with regards to price stability." So that certainly suggests that they're on point to announce a taper at the next meeting. I'm curious what your base case expectation is at this point.
It hasn't really changed much all throughout this. Even we've seen pretty big moves in rates. It's been so far in the right direction to what our forecast path has been for rates, and maybe there's some upside risks for our inflation forecast. Our rates forecast based on this higher inflation. And that also takes into account the Fed's next moves, which I think that they cannot wait, even though the jobs data wasn't that great. And overall data has been mixed, and we're still seeing this kind of dichotomy between inflation upside surprises versus growth downside surprises. At this point, in comparison to, let's say, the last business cycle where they could wait and really take their time to start to tighten, this time everything's accelerating much faster, which is really kind of a function of how the economies have responded coming out of this pandemic. Everything's been put on a faster course. I think that the November taper, for me, it's pretty much a done deal, and would really require a pretty big equity correction between now and November 3rd, just for the Fed to get concerned about financial conditions. Other than that, I think all the criteria has definitely been met. They need to get this tapering started so that they can finish as soon as possible, then eventually prep the markets for actually rate hikes.
Yeah. So as you said, that's been your view for a long time. So it looks like we're on path for that. Although, as you mentioned, a hiccup in the equity markets could certainly delay that. Great stuff as always. Really appreciate you coming on.
Thanks, John. My pleasure.
And for our listeners, just a reminder: if you are still not receiving George's strategy reports directly, let us know. You can email your MUFG sales coverage, or reach out to them in some form or fashion, or get in contact with George or me directly. Thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts, and reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.